Everyone. Uh, Sorry for the slight delay. I was just trying to reset things. If you're able to see my screen and see my audio video, hear my audio and see my video, you can just let me know. And good morning once again. And today we start with the next standard, that is Ind AS 36, right? So this week we are taking again lighter standards, but Ind AS 36 followed by whatever we do for Ind AS 105, that will also be very very important. Okay, so sometimes tricky, involves good amount of calculations, and especially understanding the questions are drafted in a confusing manner. So that is what we would be covering today. And let me just share my screen. Good morning once again, and let's now start off without wasting too much of time. Now, today we start with Ind AS 36, and Ind AS 36 deals with impairment of assets. Now, when we talk about impairment of assets, we are talking about some kind of loss. Whenever we say impaired, you would have heard this term, hearing impaired. Okay, impaired means damaged. Impaired means damaged. Now, in this standard, we talk about what do we do when we think an asset is damaged. Not only physically, it is more from a financial point of view, to understand that yes, whether I will get the benefit that I am expecting. Now, all of us know the definition of asset. When we learn definition of asset, we say asset gives us future economic benefits. And whenever we are presenting some amount as asset in the balance sheet, what we are saying or what we are asserting, you learn about assertion also in audit, right? What we are saying is that this amount, for example, one car, I am showing it at 10 lakhs. What I am communicating to the users of the financial statement is that from this car I will get benefits of at least 10 lakhs. That is why I say this is an asset worth 10 lakhs. Now, sometimes what happens is, due to some multiple reasons, for example, car met with an accident, or some part of the car got damaged, or if I'm running taxi business and because of COVID I'm not able to run the business, or the purpose for which I had purchased the car I'm not able to use. When these things happen, I will not be able to get the future economic benefits that I am expecting. In that case, we may see or we may say that this asset has been impaired. Means there is some kind of loss, there is some kind of damage. And that is what we will understand in this standard. Please remember, impairment is not depreciation. Impairment is more about when I have an asset, when I look at a particular asset, will I get the future economic benefits that I was expecting? If no, then there is a likelihood that the asset is damaged, or we have some kind of loss on that asset, and this standard tells us how do we account for all of those aspects. Okay. Now, just a quick recap of what is not covered in the standard. Inventories are not covered. Now, why inventories are not covered? Inventories anyway we value using lower of cost or NRV principle as per Ind AS 2. So, when we are saying NRV, which means NRV is what we will be recovering. So, anyways, we are showing it as a at a lower of recoverable or cost amount. Hence, you don't need to do inventories. Then contract assets and assets arising from cost to obtain or fulfill a contract, which is covered by Ind AS 115. Deferred tax asset. Now for deferred tax asset also, what Ind AS 12 says is, you should create a deferred tax asset to the extent you believe that you will recover that deferred tax asset. So again, there also recoverability criteria is met, and hence covered under Ind AS 12. Then assets arising from employee benefits plan, that's covered under Ind AS 19. Financial assets, very big and important standard. When you talk about investments, when you talk about receivables, when you talk about loan given, and all of those aspects, that is covered under Ind AS 109. Then biological assets like cow or other plants which are not PPE, that's covered under Ind AS 10, Ind AS 41. Agriculture, again there fair value less cost of sale, cost to sell, so that would be covered there. Then assets arising out of insurance contract, covered under 104. Then non-current asset held for sale. So even non-current asset held for sale, which we will be doing subsequently, that will be valued using Ind AS 105. There also we will use the amount that we will get fair value less cost to dispose and all of that. That part will be covered under Ind AS 105, and the standard applies to. So it doesn't apply to all of those. It applies to financial assets classified as subsidiaries, associates, joint venture. So if you have classified a financial asset as subsidiary or associate or joint venture, then you need to apply this particular the requirement of this particular standard. Right now, when I say impairment, what do I mean? So when I say impairment, what do I mean? So always remember, before bringing any asset to the standard, for example, if I have car or if I have plant and machinery, you calculate the carrying amount as per the respective standard. So we have something called as the carrying amount. Now what does the carrying amount tell us? We are saying that we will recover this much of amount from this asset. So let us say carrying amount is 10,000 for example. Okay. Now if I have to sell this particular asset, if I have to sell this particular asset, or if I have to determine its fair value, I will get some amount. So for example, this car, has a fair value of, let us say, 12,000. Today in the market, the fair value is 12,000. If I have to sell this car, I call it cost to dispose or cost to sell, I have to incur, let us say, 1,000 rupees. So fair value minus cost to dispose or cost to sell is 11,000. Fair value minus cost to sell is 11,000. Means I have an asset worth 10,000. If I sell it, or if I determine the fair value, I'll get 12,000, and to sell that asset I have to incur a cost of 1,000. So 12,000 minus 1,000 is fair value less cost to dispose. Then this is the first calculation. The second calculation is what we call the recoverable amount. Means how much amount will I recover from this particular asset by using it. Now for that, what we calculate is present value of cash flows. and let us say the recoverable amount is 9,000. Now, if you were having this asset, what would you do? Would you use the asset or would you sell the asset? By using the asset, you get benefit of 9,000. By selling the asset, you get a net amount of 11,000. What would you do? Would you use it or would you sell it? Come on, would you use it or would you sell it? You would sell it, because unless you need the car, of course, you would sell it, because by selling it, you will get 11,000. So, wherever there is a higher possibility, I would do that. If recoverability was higher, I would have recovered it. Okay. So, the higher of these two amounts, sorry, I wrote here recoverable. This should be value in use. The value in use, that is the cash flows that I will generate by using that asset, is called value in use. Now, higher of these two, I will always think, what will I do higher? What will I do? Wherever I'll get higher, I will take that course of action. So, wherever I get higher, I will take that course of action. That higher amount will be called, higher amount is called recoverable amount. So, here the higher of the two, recoverable amount, is 11,000. Now, if my carrying amount is less, or the other way to understand that is, if my recoverable amount is greater than the carrying amount, then there is no impairment, because I am saying it is 10,000. I will get 11,000. I will recover 11,000 from that asset. So, where is the loss? There is no loss. But for example, this was 8,000. So, my fair value less cost to sell is 7,000. My value in use, earlier I wrote, by mistake I wrote recoverable. Value in use is 9,000, that is present value of cash flows. So, the recoverable amount will be higher of 2, that is 9,000. Now, I am saying my asset is 10,000, but I will get only maximum of 9,000. I will recover only 9,000. So, what the standard says is, by showing the asset at 10,000, it will be incorrect. You please bring it down to 9,000, and there is an impairment loss of 10,000 minus 9,000, which is 1,000. Impairment loss of 10,000 minus 9,000, which is 1,000. This impairment loss is debited to P&L. This impairment loss is debited to P&L. Any questions so far? So, impairment loss is carrying amount minus recoverable amount, where carrying amount should be greater than the recoverable amount, or recoverable amount should be less than the carrying amount. Carrying amount is your cost or revalued amount as per the respective standard. Ind AS 16, Ind AS 40, Ind AS 38, whatever the standard has said, calculate as per that standard, and that is the carrying amount. So, first you have to do as per the original standard, and here you have to calculate fair value less cost to dispose and value in use, which is present value of cash flows. Higher of the two is called the recoverable amount, and if recoverable amount is less than the carrying amount, there is an impairment loss which you need to calculate. Now, two important aspects. Depreciation versus impairment, both of these are not same. Depreciation is allocation of depreciable amount on a systematic basis over the life of that asset. Okay, so that is one thing. But impairment, for impairment, we will check whether there is some kind of loss. Depreciation will keep on charging. We have decided, okay, 10% depreciation will keep on charging. Impairment, on the other hand, we will see, is there some kind of loss, and then we will calculate the impairment of that particular asset. Sir, for administrative asset, can we estimate value in use? If we cannot estimate the value in use for an independent asset, we will understand a concept called as cash generating unit. Okay, so there we will say, we will keep on aggregating the assets and calculate the value in use for the cash generating unit as a whole, CGU. Will come to that. Okay. Now, the general rule is, at the end of each reporting period, you have to check whether there is any indication that an asset may be impaired. So, first thing you have to understand is, every year you don't need to check for impairment. Every year you don't need to calculate impairment. What you need to first do is there any symptom, is there any indication? Like, every year you don't go to a doctor, right? Or every 3 months you don't go to a doctor. When do you go to a doctor? When you see there is symptom, there is something, there is a symptom, there is a fever kind of a thing, or you are having some symptoms of fever, cold, cough, then you go to a doctor. So here also, at the end of each reporting period, you decide or you check, is there any indication, is there any symptom that an asset is impaired? Okay. If there is any symptom, then you calculate the recoverable amount and calculate the impairment. For example, if the machine is running perfectly, the business is doing well, we will recover the amount, we know that, we will not do this impairment testing. But the machine got damaged or the market demand got low. So for example, if you look at Jaguar Land Rover, the sale of the vehicles had gone down, it was pretty low. So Tata as a group, they had to check for impairment of their investments. So there they realized that yes, there is some kind of impairment. They wrote some 35 or 40,000 crores. I'll share you the details in the group. You can have a look at it. So when there is an indication, you will calculate the recoverable amount and you will calculate the impairment loss. But there are three cases. We have already covered this intangible asset part in the previous session. There are three cases where, whether or not indication exists, you have to test for impairment annually. What are those three cases? Intangible assets with indefinite useful life. So, because the life is not definite, you are not amortizing it, you have to do it. Second, intangible assets not yet available for use, means they are maybe under development. And third, goodwill on business combination. So, for this, you have to perform at least annually. Perform at least annually. So, when to perform? Every maybe March you can perform, or every January you can perform. At least once in a year you have to perform. It is not at the end of the reporting period. At least annually you have to perform the testing for impairment. Now, how do we get to know the indicators of impairment, or how do we get to know that there is a symptom of impairment? Now, there can be some external source or there can be some internal source. External source is maybe decline in market value. I purchased an asset at 5 lakhs. Now in the market, it is being sold at 2,50,000. So there is a possibility that the value of the asset would have gone down. Okay, because when there is a decline in market value, your fair value less cost to sell also will be reduced. Then significant changes in various other external environment factors like technology, market, economic, legal, and all of that. Now, what does this mean? For example, I purchased a computer for my animation purpose. Now, in the market, technology is changing very quickly. AI related tools have come up. I can get better output using new types of computers and technology. Now, when this technology changes fast, my existing computer may not be able to recover the amount. So I can say the existing computer may be impaired. Then, if there is increase in market rates, now because of this, what happens is, whenever you discount cash flows using higher interest rate, will my present value be higher or lower? Can you just tell me? Will my present value will be higher or lower? If my interest rate of discounting has increased, what will happen to my present value? Yes, Saisham, Kanishka Shivkumar, yes, lower. So my present value will be lower. And if you remember the calculation what we did, we said recoverable amount is lower, higher of fair value less cost to sell, cost to dispose, and your value in use. So when my value in use or PV will go down, the amount, my recoverable amount may also go down, and hence that is an indication that there is an impairment loss. Okay, then carrying amount of net asset is greater than market capitalization of the entity. So this happens in case of listed entities. This is one indicator that if you look at the net asset, let us say these are 100 crores. The listed entities market cap is, let us say, only 80 crores. So market has already discounted. Market has said this entity is worth only 80 crores. That may be an indication of impairment. Now coming to internal sources, these are external sources. Internal sources are physical damage. The factory got damaged, the car got met with an accident, something like that. Or significant changes in use or expected use of an asset. Now, what does this mean? I bought that asset for one purpose, for creation or for manufacturing of, let us say, computers. Now computers, the market demand is going down, and because of which I am not able to manufacture computers. I have diverted that to manufacture, let us say, some other components of some chips and all of that, not the lace chips. Chips means the chips which are used in computers. Okay, earlier I thought I'll manufacture computers, now I'm manufacturing only chips. Now because of that also the value may go down. Then evidence is available from internal reporting that economic performance of the asset will be worse than expected. Now, for example, I purchased an asset. Internally, the management also discusses, okay, we will use this asset for this particular purpose. We will spend so much of amount in using this asset. From this asset, we will get so much of benefit. All of that, the management will be discussing. Now, if you look at the report, you feel that they are thinking that the cash inflow from the asset will be lower, or the management is estimating that now you need to incur higher maintenance cost for that particular asset. These may be indicators of impairment. Now, how you need to correlate this is, if I'm incurring higher cost to maintain that asset, then what happens? I'm spending higher amount to maintain that asset. My cash outflow will be higher. My present value of cash inflow or net cash flow will be lower. So that could be an indicator of impairment. Then decline in budgeted cash flows, operating losses, all of these parameters, they give some hint that yes, the asset might have been impaired. Okay. Then these two aspects, external source of impairment, internal source of information for impairment testing. Make your list and revise it. Sometimes you may get short notes, or what are the indicators. You need to explain the management what are the indicators. That kind of question may come up in the examination. Then, whenever you talk about investment in subsidiary, JV and associates, so for example, Reliance is invested in Jio. Then carrying, now this you will be able to understand slightly better when we do consolidation and all of those aspects, but still, carrying amount of investment in separate financial statements is greater than carrying amount of investees net assets in the consolidated financial statements. Now what does this mean? See, I'll just give you a brief of what we would do in consolidation. Advanced concepts we will understand subsequently in business combination chapter. Let us say this is Reliance, this is Jio. Okay, Reliance has invested 100 crores. Reliance has invested 100 crores in Jio. Now in the standalone financial statement, we'll understand subsequently. You can Reliance can carry this at multiple ways. Okay, so I'll not get into all of that. Standalone financial statement, let us say this is being carried at our amount of 100 only. We're carrying it at cost only. But Jio initially had net assets of 100. It earned a lot of money and it paid dividend of, let us say, 40. Initially net asset of 100, it earned a lot of profit, and dividends it has paid is 40. Now the amount that is left in the balance, the net assets, if you look at Jio, you will have only 60. You have only 60. If you see the carrying amount 100, but in the consolidated financial statement, the net asset is 60 only. The net asset of Jio is 60 only. If this kind of scenario exists, then there may be an indication that the investment might have been impaired, because we will not be able to recover the entire 100 amount from the from the subsidiary. Okay, this is just one example where the net assets of the subsidiary has gone down. Or another case could be ignore dividend, it losses of 40. Now, if the losses are 40, then the net asset of the subsidiary is 60. The net asset of the subsidiary is 60. But in the standalone financial statement, I am saying the cost is 100. So in that case also, there will be an indicator of impairment. Okay, so this one a simple example to understand when can impairment happen in case of such kind of investment. Then, if the subsidiary is paying dividends more than the income of the subsidiary, that also could indicate that investment has been impaired. See, this doesn't mean the subsidiary is doing bad, just that we have already collected the dividends. Now, after collecting the dividends, will I be able to show that investment at 100? That is the question. For example, if the company has distributed everything, all the reserves, everything has been distributed, that investment may no longer be worth 100. In that case, we have to calculate impairment, right? So these are the two aspects of indicators: external, internal, and specific for investment in subsidiary. Two scenarios: when carrying amount of investment is greater than carrying amount of net asset in the consolidated financial statement, and dividend paid is greater than the total comprehensive income. So please understand, when you pay dividend, assets have gone down in the business. If the company has distributed everything as dividend, you cannot say my investment is worth 100. So that is another aspect you need to be mindful of. If you have any questions, feel free to ask. Otherwise, we'll continue. Then, after we have identified that there is impairment indicators, we have to calculate something called as recoverable amount. And the recoverable amount is higher of fair value less cost to dispose and value in use. We have already seen this calculation. Fair value less cost to dispose and value in use. Whatever is higher, that is called impairment. Right? Now, two things you have to understand. This standard specifically, when I have to calculate fair value and value in use, there is a lot of effort involved. For example, for value in use, I have to estimate the future cash flows, discount it, arrive at the present value, and all of that would be there. So what the standard says is, if in some cases, you have some scenarios there, you don't need to calculate both fair value and value in use. First one, if either of these amount exceeds the assets carrying amount, which means my asset carrying amount, for example, is 100. Fair value less cost to dispose is 120. Now, when that amount is 120, I don't need to calculate the value in use, because 120 is greater than 100. Anyways, the asset will not be impaired. Then, if there is no basis for making reliable estimate of fair value less cost of disposal, so there is no proper open market where I can estimate the fair value. The fair value estimates may not be reliable. Then in that case, what do? We don't calculate the fair value, we will just say value in use. Then, if previously we have calculated recoverable amount, which is significantly higher than the carrying amount, then again, immediately you don't need to perform those unless there are other significant changes, right? So these are the things for calculation of recoverable amount. Now, recoverable amount you can calculate for an asset, but then in some cases, you may not be able to calculate the recoverable amount for a standalone asset, right? For example, let us say there are three machines. There are three machines in a factory. All the three machines are used in manufacturing of a single product. Now, I cannot say this one particular machine has a specific amount of value in use, because cash flow is generated by all the three machines together. Or there could be cases like corporate assets, administrative asset, corporate offices, where they don't generate cash flows. So in those cases, we will not be able to calculate the value in use directly. We will not be able to calculate value in use directly, especially in cases where the assets cannot generate cash flows independently. Or take a case, let us say there is a hotel. Okay, in that hotel, you have hotel rooms, you have restaurants, you have swimming pool, you have gymnasium, you have so many things. Now, you can't say that the gymnasium is generating revenue independently, because gymnasium is linked to the hotel. and hotel may not be charging separately for the gymnasium or pool access. So that is not generating cash flow independently. So what I have to do is you have to look at the entire hotel as a single structure or a single group. That is why it's called cash generating unit. Unit means group of assets. Also liabilities also can be considered, especially when you have branch divisions and all of that. Now in a hotel there is a separate restaurant which is generating its independent cash flows. In that case, restaurant will be separate, the remaining part of the hotel will be separate, right? That is what is called a cash generating unit. Now at what level should we see cash generating unit? You have to see lowest possible group of assets which can generate cash flows. Don't say that entire company I'll calculate cash flows. Lowest possible assets. For example, a specific branch or a product line or a specific factory premise. One group of assets which independently can generate cash flows. If some group of assets cannot generate cash flows, you have to keep on adding assets and you have to generate cash flow. You have to calculate CGU. Now, 2-3 things you have to keep in mind here. Number one, just because a branch, so I'll just give you a very classic example to understand this one. There is a refinery and there is a marketing division. Now, what happens is this refinery doesn't sell products in the market. Refinery transfers the product to marketing division and marketing division goes to the market and sells. Now refinery is selling to marketing division. Now just because there is an internal transfer does not mean that refinery, the cash flow of the refinery cannot be determined. You have to calculate something like maybe a transfer pricing and see what is the cash flow which is attributable to the refinery or what is the value that the refinery would be generating. Okay, so it is not that just because we are not selling the product outside, we say that value in use cannot be determined. Now, what is the CGU? If recoverable amount cannot be determined for an individual asset, you determine it for a CGU. Now, CGU is the lowest aggregation of assets that generate largely independent cash inflows and is also monitored for internal management purpose. So, it generates cash inflows independently. If an active market exists for the output produced by the asset, that asset or group of assets shall be identified at CGU even if some or all of the output is used internally. So that's the example that I give you. If output is used independently, if power plants are generating electricity for internal use, we can't say that there is no cash flow because there is an active market possible. Then we understood about fair value less cost of disposal. Fair value we'll understand again in detail in 113. Cost of disposal are incremental costs which are directly attributable to the disposal of an asset, excluding the finance cost and income tax expense. So, cost of disposal means if I am selling a particular asset, if I have to pay some amount as let us say commission, brokerage, sales commission or all of that, those costs which we will incur because we are selling is called incremental cost which is attributable to disposal. If I am just using advertisement and all, that is not incremental cost because that is I am trying to get buyers. Okay, so stamp duty, cost of removing the asset or any other incremental cost, if I have to dismantle that asset, any cost that I need to incur to complete the selling transaction, that is called cost of disposal. What we will exclude? We will exclude the finance cost and income tax expense. And this same discount rate also when we calculate, we will exclude the finance cost and income tax related aspects so that there is a matching concept. Okay, so some costs like cost terminal benefits to employees. For example, I have to shut down a factory and I have to give retirement benefits to that employee. Those are not cost of disposal. Or if I have to reorganize the business, I have closed a branch and I have to reorganize that business again, those are not cost of disposal. Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes or no, you can just confirm it down, right? Okay, any questions so far? Yes Anybody taking tea break, coffee with ghee like yesterday? Okay, no questions? Great. So either I'm teaching so well that you don't have any questions, or you are understanding, you are an excellent student and you have understood everything, you are absorbing everything and hence no questions. That is good. See, questions when I say need not be from the this topic, discussions that I had. Questions can be some doubts you had before the class. Even that you can ask. Okay, no questions, no questions. Fine. Now, moving on to the next part. So, if you understand this step by step, the way you need to see this is you need to calculate carrying amount as per the respective Ind AS. Then you need to calculate fair value less cost to dispose. Then you need to calculate value in use. Okay, value in use is value in use is present value of cash flows, and present value of cash flows, when you calculate, you get the value in use and you get fair value less cost to dispose. Higher of these two is the recoverable amount. Okay, so now moving on to value in use. Value in use is nothing but by using that asset, what is the benefit I am getting, which is nothing but the present value of future cash flows. So we have to estimate the future cash flows and we have to discount it using an appropriate discount rate to get to the present value. In most of the cases, it will be straightforward calculation. But please remember, this chapter involves a lot of calculation, so you have to be careful while calculating those respective amounts. Okay. Now, how do we estimate future cash flows? You use cash flow projections based on evidence, right? Then you look at what is the management doing in terms of budget, and using the budget and all, you can estimate the cash flows. Then you can use the recent financial budget, most recent financial budgets and forecast that has been approved by the management. Now, few things that you need to understand is, should I consider or should I take the asset as it is, or should I take future improvements? For example, I have a particular machinery. As a management, I'm thinking that in after 2-3 years, I will do some revamping of the machinery. I will do some major overhaul of that machinery, because of which my cash flows will increase. Now, this future action that I'm taking, I should consider that for my cash flow purpose only if I am committed to that. Committed means I have agreed with the supplier, I have approved plan, shareholders have approved, everything is approved. So only when the entity is committed to that plan, you should include it. Otherwise, you should not consider. In future, if something I will do, I am thinking I will do. All of us think, no, we will study. Every day we will get up at 5:30. First 3-4 days you will get up and then again gone. Right? So, unless you are committed, you have committed that yes, I will do this. I am committed. I have committed to the external parties that there will be a restructuring activity. Only after that commitment, you should consider the future changes in cash flow. If there is no commitment, if you are just thinking, planning, dreaming, then you should not consider. Then period covered should be 5 years unless a longer period is justified. Then cash flows projections beyond the budget period, means beyond that 5-year period, should be estimated by using a steady declining zero or negative growth rate. So beyond the budgeted period, whatever we are looking, we should either use a steady rate, let us say 5% growth, or a declining growth rate. We should not say that, okay, in the first 2 years the management is saying 50% growth, in the next year we will get 70% growth. That kind of projection should not be done. So take the budget and apply the steady growth rate. Increasing growth rate can be used only when it is justified. So if you are saying that my cash flows will continuously increase at a very high rate, then it has to be justified. Then the growth rate should not exceed the long-term average growth rate of products in the industry. Again, what is the average growth rate in the industry? 10%. You can't say my business will grow by 25% unless we can justify that. Okay, now the most important aspect, these are just basic theory. The important aspect is what should include, what should be excluded. What should be included, what should be excluded. I suggest you to again revise it 2-3 times so that if a question comes in the examination, you are not stuck up. Okay. Include cash flows from continuing use of the asset. So whatever cash flow you will generate, which you will, by using that asset, that you should include. Then what you should exclude cash flows which are independent from the asset under review. Meaning to say, I have sold some product to the customer, already sold. Now that product which I have sold, I'll get that money from the customer whether I use the asset or not. So such kind of things like receivables and payables, those should be excluded. Means existing receivables payables, that should be excluded. Future receivables payables that will come because of using that asset should be included. So cash flows by using the asset inflow and outflow. Then net cash flows to be received for the disposal of the asset at the end of the useful life. So I will use that asset for 5 years. At the end of the 5 years, I will sell that asset. What is the value that I will get? That will be a part of my cash flow. Then day-to-day servicing, your repairs, maintenance, overheads, which can be attributed directly or allocated to that particular asset. So let's say electricity expenses, your security expenses, all of that also you should include. Then cash flows from entities restructuring plans which are not yet committed. If it is not committed, you will not consider. If it is committed, only then you will consider. Appropriate apportionment of corporate overheads. So means a proper way to allocate corporate overheads as the management does, that you should include. What you should exclude? Internal charges incurred by the CGU for using the corporate assets. So sometimes what happens is, let us say there is a head office and there is a plant. Head office says, plant, I have incurred cost of 100. My expenses out of that, computer related, IT related, HR related, I have spent 100 rupees and I can allocate 100 rupees to you. That is what the corporate, head office says. That cost you will include. Now again, you should not include that. The plant is saying, I have to pay 100 or 120 to the corporate head office. It will be double counting. Okay, so you will consider it only once. So internal charges means the plant, they actually say, okay, I have to pay to head office 100. So they will create an expense and payable of 100. Okay, actually payment received doesn't happen, but such kind of double counting should be avoided. Then cash flows that are expected to arise from improving or enhancing the asset performance. Meaning to say, in future, because we enhance that asset and because of which the cash flow will increase, those things should not be considered. If you have committed to the plan, both the plan and the related cash flows can be included. Then financing cash flows, interest and income tax, receipts and payments, all of these should not be considered. So this list is important for us to discuss the questions in the when we do it. So broadly, all inflows, all outflows, you will exclude finance, you will exclude tax, you will exclude plans which are not yet committed to, you will exclude existing receivables, payables, etc. Okay. Then for disposal related cash flow that we will sell, what we'll do is we'll see, okay, currently 5-year-old asset can be sold at what amount. That will be the disposal or residual value. In examination, they'll give you, okay, this is the residual value. No need to worry about that. Then for foreign currency future cash flows, you have to calculate the cash flows in the currency in which they will be generated and then discounted using the discount rate appropriate for that currency. Now what do I mean by that? See, okay, what is the current borrowing rate if you have to borrow in dollars? If anyone has an idea, how much would you need to pay if you are borrowing in dollars? Okay, if you don't know the exact amount, is it higher or lower than Indian borrowings? If you have to borrow in dollars, will the rate be higher or lower? Borrowing rate. Two or three plus something. Okay. See, for others also, you need to get this habit of reading papers and all of that. These, see, it is not about just passing the examination. This information like what is the Fed rate or what is the RBI repo rate hiking high, right? What is the USD borrowing rate? All of these things you should keep a track of. They may ask just in the interview, Fed rate hike, what is the impact? What is the current Fed rate? Okay, so it is important that you read and you need to follow that properly. Okay, now generally, USD borrowings are at a lower rate. Now, if the cash flows are associated in USD, first you will use the USD rate, discount it to the present value and convert it using the spot exchange rate. So, meaning to say, if there are foreign currency cash flows, step 1, use the foreign currency discount rate for that currency. Step 2, calculate the present value and then convert it into the INR value using the spot exchange rate. Okay. Now, discount rate should always be pre-tax rate, should reflect the time value of money and risk which are associated with that asset. See, there are two aspects. I will not get into too much of detail of this because not very relevant from the exam point of view. If there is risk, we can adjust the cash flow also. If there is risk, we can adjust the cash flow also. So, if the cash flows have already been adjusted, the same impact you will not give on the discount rate. For example, there is a high uncertainty or regarding future cash flows. So we have reduced the cash flows. Because there is higher risk, we have reduced the cash flows projections. Now the same risk that there is uncertainty of cash flows, you should not say I will increase the discount rate. Now this is slightly technical and from exam's point of view, you will get that single discount rate. You need to understand it has to be pre-tax rate, and second is it is based on the current time value of money and the risk. It should adjust the risk which have not been adjusted for the cash flows. When asset specific rate is not available, you can use weighted average cost of capital using capital asset pricing model or incremental borrowing rate or other market rate. If based on that you can do the calculation. Now directly you may not be able to use CAPM, then in that case you will adjust it for the specific risk related to country cash flows and all of that. Then one more thing what you need to understand is interest rate and inflation rate are linked to one another. So there is an interest rate, there is an inflation rate. Both of these are linked to one another. Now inflation will increase your cash flows. Inflation will increase your cash flows. Interest rate should also be accordingly adjusted, or interest rate also should reflect the inflation related parameter. This we'll understand when we do a comprehensive problem. How do we give the impact of inflation? Now, after doing all of these, what we get is impairment loss. What we get is impairment loss. Now, if we have an impairment loss, how do we recognize that impairment loss? If you have an impairment loss, how do we recognize the impairment loss? And this is a very, very important discussion and the crux of the entire discussion we had so far. So let me just open this. So again, I am writing the steps so that it is clear. Step 1, carrying amount. Step 2, recoverable amount, which is higher of fair value less cost to disclose and value in use. If the recoverable amount is less than the carrying amount, there is an impairment loss. Now the question is, how do we recognize the impairment loss? Impairment loss is generally recognized in P&L, meaning to say, if there is an impairment loss of 1000, you will debit 1000 to P&L and credit the asset. So impairment loss is recognized in the P&L directly. But if the asset is under revaluation model, so if revaluation model or if revaluation surplus exists, then you will debit OCI or revaluation surplus. So if revaluation surplus exists, you will debit it to OCI. Sir, revaluation surplus does not exist, then you will take it to P&L. Now one thing you have to keep in mind, it has to be asset specific. It is not that for one asset, from one asset revaluation surplus, you will utilize it for another asset. Okay. So P&L, generally if revaluation surplus for that asset exists, then you will take it to the, you will recognize it in the revaluation surplus. If revaluation surplus does not exist or is not sufficient, then in that case you will take it to the P&L. Sometimes what may happen is impairment loss is greater than the carrying amount. So why impairment loss can be greater than carrying amount? Maybe possible we have already depreciated that asset. We have already depreciated that asset. So carrying amount is near about 0. And we have to incur some cost to dispose it. We have to incur some cost to dispose it. And because of which the impairment loss is greater than carrying amount. For example, carrying amount is 1000. Fair value is 500. Cost to sell is, let us say, 800. Now 500 is the fair value minus 800. So I have to incur a liability of 300. I have to incur a liability of 300. 300, right? Now if I have to incur a liability of 300, I will not get anything. I have to pay 300 to somebody. I have to pay 300 to somebody, and my impairment loss becomes 1300. My impairment loss becomes 1300. Now in that case, what should I do? So my carrying amount is 1000. I will, by selling that asset, I'll get only 500, and I have to spend 800, means I have to pay 300 to someone. If I have to pay 300 to someone, then that 1300 becomes my cost to dispose. Now what do? I can write off only 1000 from the PPE. So what I'll do is debit P&L, credit PPE 1000, credit liability 300. I'll have to create a liability of for disposal to that extent. Then entire 1300 to be recognized in P&L. Okay. Very rarely these kind of cases come, but it can definitely come. So if the impairment loss is greater than the carrying amount, then you will have to recognize the balance amount as a liability. Then after an asset has been impaired, subsequent depreciation has to be calculated on the amount after impairment. And when you are calculating deferred tax assets, even they are done using the impairment related amounts or amounts after impairment. So if you remember, under PPE we said cost minus depreciation minus impairment. So this impairment will go back to Ind AS 16 and say, okay, you have to reduce me from the carrying amount. So first you will calculate carrying amount as per Ind AS 16, come to Ind AS 36. If there is impairment, reduce that impairment and send that asset back to Ind AS 16. Okay, is that clear? Any questions? Yes or no? if the impairment loss is greater than the carrying amount, if the impairment loss is greater than the carrying amount, for the excess amount you have to recognize the liability, right? Now what Saisam, what you are saying is the value in use will be 0. If we are not using the asset, yes, the value in use will be 0. Now that value in use will be 0, that entire 1000 will come down, that is 1000 of loss, and the liability to dispose it, if you have to dispose of that asset, that liability to dispose it of 300, that has to be recognized. So here from this PP I can write off only 1000, but because I have to take a liability to dispose it, and if I have to dispose it, this happens in case of, let us say, vehicles and all. You cannot just leave the vehicle and go away. You cannot leave the vehicle on road and you cannot walk away. You have to take it to a center where they will dismantle the vehicle, they will scrap the vehicle. You cannot scrap it on your own, and for that you have to incur cost. So let us say you cannot sell it, the selling price is 0, for example, and you have to spend 1000 rupees to dismantle that vehicle. That additional amount of 300 will be recognized as liability. So here the total loss, I would put it that way, would be 1300. I hope it is clear. Saisham, is that clear? Okay. So technically what you said is right. I will not say entire, the amount as impairment loss. And now this 300 of liability also I should recognize if, let us say, Ind AS 37 says, as per Ind AS 37, I need to recognize this liability. Only then I will be able to recognize this liability, and this 1000 I will be covering it under Ind AS 36. Okay. So that is how we will account for it. Slightly, rare scenarios, I would say, would not come up again and again. Now, moving on, when we have to calculate impairment loss for cash generating unit. Cash generating unit means individually one asset cannot generate cash flows. So we group those assets and we call them to be cash generating unit. Now when we say cash generating unit, like we do for assets, we will do carrying amount, we will calculate carrying amount for the cash generating unit, and we will calculate fair value less cost to sell for cash generating unit. So for cash generating unit, we will have the carrying amount. Now, how do we calculate carrying amount? Again, let us say a cash generating unit has various assets. As per the respective standard, calculate what is the carrying amount. As per the respective standard, calculate what is the carrying amount, right? So that is what is a cash generating unit. Now, let us say it has PPE, plant and machinery. If we talk about a branch, it has some receivables and all of that. Calculate as per the respective standard and determine what is the carrying amount. Okay, then we will include all the assets that can be attributed directly or can be allocated on a reasonable basis to the CGU that will generate future cash flows. But we will consider only those liability. If those liabilities are directly linked to the CGU and that liability cannot be excluded. So generally, you will take all the assets and you will take those liability. Only which are relevant for estimating the recoverable amount. For example, if I look at a branch, if I say the branch related assets are there, I will take all the assets. I will say, okay, this is the carrying amount of my branch. Now liability I will generally not consider because liability I have already incurred. Okay, I will not consider unless that liability is required to estimate the recoverable amount, right? Now, when would that be a case? For example, when would be a case that I need to consider a liability? let us say there is a decommissioning related liability. Now the decommissioning related liability is linked to my property, plant and equipment. So I will take the property, plant and equipment. I will also take up the decommissioning related liability, right? So that is how you have to understand what to include, what not to include. Then I will also calculate the amount which is the value in use by considering the cash flows generated by the CGU. So cash flow, the value in use is present value of cash flows generated by the cash generating unit. So whatever is the present value of cash flow, I will calculate and I will find, okay, this is the value in use. Now, impairment loss in case of CGU, this immediately now we'll take up one example. Impairment loss, how should we allocate into for the CGU? If I have said that, okay, this branch has an impairment loss, of, let us say, 1000, how should I allocate that? First, you will always, just give me a moment, there is, I need to take up a call. Hello, hello, mine, हाँ भैया बोलो, 7, हाँ ठीक है, मैं आपको कॉल करता हूँ, अंदर आना, मैं आपको कॉल करता हूँ 15 मिनट्स के बाद, है ना? Sorry, I had to take that call. That's why the thing. Okay. Now, how should we allocate? How should we allocate the impairment loss when it is from a cash generating unit? First, if there is any goodwill, first always remember, if there is any goodwill, reduce the carrying amount of goodwill allocated to the CGU or group of units. So whatever is the goodwill, first target is goodwill. Okay. Then the remaining assets will allocate pro rata on the basis of carrying amount of each asset. So whatever is the carrying amount, which carrying amount, as per the respective standard, whatever is the carrying amount, considering that we will allocate the impairment loss. Okay. Now this table will understand after we solve one particular question. So let me just pull out one question for this and we'll solve that and understand this in a better way. Okay, so let's have a look at this particular question. Earth Infra Limited has two cash generating units A and B. There is no goodwill within the units carrying values. The carrying values of CGU are CGUA 20 million, CGUB 30 million. The company has an office building which is used as office headquarters and has not been included in the above values and can be allocated to the units on the basis of their carrying values. So now this is a case where what we have is there are two cash generating units, CGU A and CGU B. Okay, CGU A has 20 million, CGU B has 30 million, and also there is an office building. Now, office building is called a corporate asset. Now, that corporate asset is not directly attributable to the CGU, it has to be allocated. And how do we allocate the CGU? How do we allocate the corporate? Just a second. The company has an office building which is used as an office headquarter and has not been included, means we have not included that in this 20 million and 30 million, and can be allocated to the units on the basis of their carrying values. Now here CGU does not include the corporate office, and now we have to include this office building, whatever is the carrying value, to the respective CGU, and then determine whether the CGU A or B are impaired or not. A very simple question, but it will help you understand how do we allocate the corporate assets to respective CGU. Right now, carrying amount CGU A, CGU B. Carrying amount is given to be 20 million and 30 million. Okay. Now, this 2030 does not include building. But please remember, if I am saying value in use or if I am calculating the recoverable amount, I am saying by using this CGU, I will get 18 million of benefit. By using the CGU A, for example, in this question, I will get 18 million of benefit. Correct. Now, if I am getting 18 million of benefit, that is not only by using the 20 million of CGU, I am also using the corporate asset. Now this corporate asset I have to allocate between A and B in the ratio of the carrying amount. That is what is given in the question. So 10 million divided by 30 plus 20 is 50, multiplied by 20 it is 4, and this becomes 6. So my total thing becomes 20 plus 4. 20 plus 4, 24, and CGUB becomes 36. Now, the value in use is given to be 18 and 38. Now, tell me, is the CGUA impaired or is the CGUA impaired? Is CGUA impaired? Now, when CGUA is impaired, what we have to do is the impairment loss of CGUA is 24 minus 18, 6. Now, this impairment of 6 should be allocated between the carrying amount of the CGU and the corporate asset in the ratio or in the proportion of the carrying amount. So, impairment loss would be for CGUA, you would say total loss is 6. You divide this by 24, multiply this by 20, 5 you will allocate to the CGUA. 5 you will allocate it to CGUA, and corporate asset you will say 6 divided by 24 multiplied by 4. 1 you will allocate to the corporate asset. Now, even within the CGUA, this 5 of loss, you will say what is the carrying amount of each of that asset, and in that proportion or in that ratio you will allocate the goodwill, you will allocate the impairment loss. But first, if there is impairment, if there is goodwill in the carrying amount of CGU, or if there is goodwill in the CGU which we are evaluating, then we will first make goodwill zero and then bring the asset down to their respective amount after impairment loss. Now one more thing you have to keep in mind here is, if for example this corporate asset has a fair value, I'm just saying corporate asset has a fair value, if for example has a fair value less cost to sell of 15 million, then I cannot say the corporate asset is impaired. Then in that case, entire amount of CGU, the impairment loss, will be allocated to CGU A, that is cash generating unit A. Okay, so what we need to understand here is, when we are allocating it to other assets in the group, then the carrying amount of the individual asset within the CGU or the allocated CGU shall not be reduced below, you cannot reduce it below 1, 0. Of course, you cannot have the carrying amount as negative number. That's the first thing. Second, below fair value less cost to dispose or value in use. Meaning to say, you cannot bring in, if an individual asset has a recoverable amount, you cannot bring that asset below that recoverable amount. If an individual asset has a recoverable amount, you cannot bring that individual asset below its recoverable amount or below 0. You cannot make it negative. For example, goodwill. Goodwill, you cannot make goodwill negative, right? So whatever is the goodwill, you will eliminate it, and then remaining loss you will allocate between other assets. Is that clear? Any questions? Why are we making goodwill 0? Okay, now goodwill is one thing where we are not able to estimate its value independently. Okay, that is why we do not recognize internally generated goodwill also. So for other assets we may be able to make certain estimates, but for goodwill we will not be able to value properly that, okay, what should be the value of goodwill. And the other thing is, if you leave this discretion, now what is goodwill? Goodwill is something which is generated because of the brand value associated. When I say my company has a goodwill, what am I saying? I have a good reputation. Because of this goodwill, I will generate additional profits. I will make super profits. That is what we're saying. Now we are saying my asset is no, my that entire CGU will not be able to recover the entire amount of the CGU. The first thing that gets impacted, or first thing we see that would be impaired, would be goodwill, because that is something which we cannot measure reliably, which cannot be separated. So if for example I am saying this asset is worth 100 and goodwill is 40 in that, which is intangible, which we have not amortized, that particular goodwill is helping me, or it is keeping that CGU worth 100. Now when I am saying this CGU is now worth 80, first thing that I will feel is lost is the goodwill part, which is to the extent of 20. Okay, that is why we write down goodwill. We are not saying making 0. First impairment loss we will allocate it to goodwill, because that is something which we don't measure, or we cannot measure the cost and all reliably. See, for all the other individual assets, you can anytime calculate what is the sell fair value, correct? You can sell that asset in the market and get the amount that you will be getting it. But goodwill, you cannot sell it independently. That is why first impact goes to goodwill and subsequent other impact goes to other assets. Any more questions? Okay, so we'll conclude here. I have to attend someone, right? So I have to attend someone, and then we'll continue tomorrow. Sorry for this, last minute notice. Someone is leaving from home, so I have to attend them. We'll continue tomorrow. We'll take up another one more question on allocation of impairment loss between different assets, and then we'll continue to discuss about NCI related goodwill allocation, fair value, and all of that. That is very important illustration for your examination. That part also will be covering along with it. Okay, thanks a lot, and have a nice day. Please go back and revise these concepts once again, so that it will be easy for you to calculate the amounts or calculate the impairment losses tomorrow. So we'll also do one question based on estimating the cash flows, right? Chalo.